reminded everybody that they don't target currencies. The only reason they'll look at it is because, yes, if the currency got too strong, it would have a negative impact on inflation, which is what their concern is. Okay, no question about it. We got that. The problem is the obvious question, and it's an obvious question. Well, is there any, because she said that they discussed it in depth at the meeting. Was there anybody who saw anything positive and likes a stronger currency? Not one raised that issue. They were all just followed upon the same, even Madame Lagarde got, finally she had to, let me go back and basically, so she was getting frustrated too. But nothing, for all the hoopla early all week, we really saw nothing. Okay, Andrew, let's get at it.
I'll get at it with you in a second, but if you were in the press gallery, what was the question you would have asked her?
Was there anybody, were the Germans in favor, or are they not opposed? I could ask it several ways, to a stronger currency. Do they see that as possibly, because she spoke, the concern about it, of course, is its impact on inflation. And its impact on inflation, of course, is seen as a negative because it's acting to drag the inflation level down, which will keep the ECB on its aggressive path for longer. So my question would have been, well, was there anybody in favor of it?
Yeah.
I mean, to me, that's an obvious question. Why do we only speak about weakness?
Yeah, I agree.
Why do we only speak about weakness? The Germans have been strong, monetary advocates, and strong monetary policy begets a strong currency. A Schwarzschild budgeting process gets a strong currency and provides the Germans with the latitude at this point for fiscal stimulus that a lot of others don't have. So,
well, particularly now, as you read very early, that they've got effectively a covered bond in essence, in much stronger than the Americans in terms of that.
Yeah, and she actually spoke to. I mean, if you listen to her, she gives you a lot, and then she gets frustrated at the same points I get frustrated at. So I give her that much credit because, come on, you know what? Okay, I know everybody needs their FaceTime. Everybody gets their 15 minutes of fame, but you know what? Get a little more. Challenge her. She's willing to give you and work with you. Challenge. Just don't keep asking the same questions over and over and over again. You know what?
Okay, so that gives me a great segue to my real question.
Okay.
That because your frustration means that nothing really changed tonight. What you said.
Right.
Was that press conference like a Biden press conference?
Was it like a what?
A Biden press conference where he's asked questions that have no wrong answer?
No, I think it's not at all. I think that Lagarde's press conferences are really well done, and she give it to you, and she's willing to admit when she's and put it to a questioner going, come on, I've answered this already. How many times? How much more explicit can I be for you? Because they don't listen. Okay, it's like being on CNBC. They don't listen. They want to know. They want you to feed them. And I know, and I could speak to this. Not Santelli, because Santelli and I don't review. When I'm on with Rick reads the blog when I write it, and pays attention. But he doesn't call me and say, "Well, what should we?" That does not take place. Well, when I used to go on and be on with a lot of others, they would always, I'd get an email or a call. Can you send us, because they want basically me to do their work. And that's one of the reasons that they stopped putting me on, because I'd say, no, read the blog. I'm not spoon feeding you the questions. You have to work to find, to question. So They don't like that. And they just don't listen. They don't listen to answers because they're already preconceived. So, and it's nothing like, Biden, Pete, you put that in, you want a political response. It doesn't play because Lagarde will give you real answers. I'm really impressed.
Okay, well, I just, that's good. I kind of just view Lagarde's position, why she was called to this, because she's very adept at representing the political agendas of the elites and communicating in the political sphere. And the actual structural economic crisis they're in is so deep and entrenched that there's only political solutions that are not, in keeping with what the original agreements were to the European Union and the EU and the Eurozone. And so she's the best pick for a shot at saving the whole thing on using political means.
Well, as she reiterated again, there was actually a good question at the end. I think the guy from the FT, believe it or not, and he said, what things would you like to see? And she reiterated again, which is what her real task is here: banking union and a capital markets union. Okay? She can't be more explicit about that. That's the road she's going down. And she applauded the 750 billion COVID bond deal. And she actually told them, why she liked it, because it comes in the form of grants. Exactly what, Wolfgang Schweibel spoke to. And I wish she would have invoked his name. But she gives you a lot, not like Draghi. Draghi was pure nonsense. He was going to go down, as he said, I'm here to preserve the euro. She's, I think, moved way beyond that. And she actually gives you things as she sees them. And if you listen, she will take you places. And through her frustration, she would like to be able to put more out there. But the questions have to be directed at that. Look at anything that was planned according to the Growth and Stability Pact that was part of the Maastricht Accord was blown apart by Draghi, because he said, there's no, I'm quoting him from 2012, do whatever it takes, and there's no taboos. So everything is available. So she's not responsible. That is long gone, because Draghi blew that apart, and they sat there, and Merkel ran interference for him to be able to do it, because the German and French banks were on the hook for so much money. And so that had to be done. Now, again, so now with what Draghi did, this balance sheet, and actually I'm going to speak to that because Lagarde was really good in what she said, far better than what Powell did, because she talked about notes. She talked about she has no plan. They will not shrink that balance sheet. They will start raising rates before they start shrinking the balance sheet. Unlike Powell, who got himself in trouble because he did both simultaneously. That will not take place here. Now, again, I didn't hear one question after she stated that to follow up to that, because they're all preconceived and don't listen. But that was an obvious question. But I basically stood up and applauded, because the ECB will start raising rates and then worry about shrinking the balance sheet well after the fact.
Okay, so
a very important point.
Mr. Harris, if I default to the other side, can I ask you a question?
Yeah, you can ask. That's what we're here for.
Okay, so, and I think that's the assumed price. I think the assumed price is that, the Fed wants to run the 2% plus, and the ECB is doing the same. So that's in the price. So we need to, we're assuming that they can we can create inflation that way, right? Because they've done that for the last 45 years, get inflation that way.
Well, I'm a believer that they can. There are others who think that the more
So,
you,
so my question is, if, and I agree with you that, well, I'm not suggesting you are saying that will happen, but that they will get there through hook or crook. But is the current pricing of the market, with the interruption of last week and we are today, where they can do it, or will the market force them to do what the Fisher paper needs it to happen?
yeah,
That is another deflationary event.
that's the
Good
penultimate,
morning.
I think, Andrew. And going and bouncing around between David Rosenberg, Lacey
Lacey.
Content, and myself. I mean, you're right in the middle of it, so I know that's why we're going down that road. And
Yep.
it is dependent.
Otherwise, we all just buy gold, buy equities, and go to bed. Because this is the question I think everyone on this phone call needs to think about, right? Because if it's that easy, we just go to bed and go to the beach and just do it. I'm just positioning. I don't think it's that easy, because I encourage everyone, and I know how much Ira respects Lacey Young. I just don't think the path's going to be that easy. I think it will end there, but I think the trajectory will be much bumpier than it assumes now.
You mean in creating inflation?
Yes.
Yeah. Well, I mean, that's what some very intelligent people believe too. And I have no, I'm certainly, I've locked up with them. So to say I won't lock up with them, but I see their point. And from an Austrian school, I see their point. When you pile on debt, that, that it creates its own economic drag. But how far will the Fed go? And my view is, because when you compare Japan, you make a categorical mistake. Right now, comparing the euro is a categorical mistake, because the U.S. has reserve currency status. So they have the wherewithal to create massive amounts that will get initially absorbed in the global system, because it's a dollar-based system, until it can't take anymore. And then we'll get to that point. What is that exact point? I can't tell you. And I'd be very skeptical about anybody who could. But I think that we will see it, and that's a big part of my view, is that that's why the dollar is so critical to understanding so much of this. Because a real sell-off in the dollar, and I mean, like Steve Roach, who called for a 30, didn't call, he from his analysis, he was looking at a 35% depreciation in the dollar. When did he write that? Back in June, I think. And he's had it out there, I was in a Project Syndicate piece. But it's made its way to others. So, that's the camp I'm in, and that will reflect whether or not, to me, the inflation story takes hold.
No. And respectfully, that was a great call. And I agree, and I know how you think. Well, sorry, I shouldn't say that. I think I know how you think. If the dollar strengthens, then I think you'll be deferring to a deflationary. Look, in the end game, they're not going to back away from inflation. They must. They've said it. So it's whether we go through another deflationary event to get there, or we are there now. That's the only question we're asking, right?
Right.
Right. So,
right.
And so as a portfolio person or a trader, you have to frame yourself that way. I find I'm kind of, and I think, we probably picked it up. I probably am in the camp that we will get a deflationary event before the inflationary event. I think Ira's probably in the other camp. but both of us will default to the camp, as would anyone in the room, if because ultimately there's 5 levers that ultimately create financial conditions to ease, right? Credit, rates, the US dollar is one, and equity prices. There's one more I forget, but ultimately they've lost 2 levers. They can't push rates any lower. Credit's already gone. So they've only got 2 things really to ease conditions. It's equity prices and the dollar. So they're kind of cornered. Now, I have to always, my view is I default to Lacey Hunt because he's got it right for so long.
Right.
And in QE has been deflationary. Credit on credit without production of income of credit is not producing GDP. It's an output gap. So he goes, you're dragging forward GDP. Now, the debate that everyone's saying about Lacey is, has he gone over the Rubicon because they went, because the Fed now appears to be monetizing the deficit. Now, I think Lacey's essentially saying yes, but he's not saying yes yet because I don't think they are. So everyone forgets that in 2008, Obama met the GFC. I think my base case is we're going to have a deflationary event into the election, and whoever gets elected will change the Fed Act, and we're going to go from deflation to inflation and then hyperinflation. I think so. And the only thing they'll give me a sign of that is if the dollar strengthens.
The US in new COVID cases with re-emerging hotspots.
Sorry, I apologize. I'll turn it off. If the dollar strengthens, if the dollar doesn't strengthen, my thesis is wrong. 100%.
Oh,
Hey, Andrew.
Yeah.
It's Angelo. I just got, yesterday I got Gary Schilling's September report. Would you like me to read his deflation outlook paragraph to you?
Sure.
Okay, here goes.
Please do.
Okay. And this is basically why I've been thinking that what's going on right now is transitory as far as the declining dollar goes, but via inflation. But anyway, so he says, look for deflation, not inflation. Many fear a resurgence of inflation, and the CPI and PPI have climbed recently, as well as inflationary expectations. They point to the massive unspent monetary and fiscal stimuli, with more to come, and Trump's stimulative action ahead of the November election. Nevertheless, deflation is in the cards fundamentally because ongoing globalization combined with the Asian savings glut puts tremendous pressure on most prices. It would take stringent protectionism curbing imports combined with rampant domestic demand hyped by continuing massive monetary and fiscal stimuli to rekindle inflation. There's a ton in there, but interesting nonetheless. And basically, Gary and Lacey Hunter, they're operating from the same playbook.
Oh yeah, totally. And I'll step in there and I think trading through the cycle against cyclically is very different. I think the IRA call on the dollar weakness from 108 to 118 or what was it now? Yeah, 119 on the euros. That's now those guys I think are still trying to work out what that transmission is. I stand with their view on that, but I need evidence in the market pricing at the moment. With the dollar weakening, the jawboning or otherwise, is working.
Well, look at your SPU bonds on the 240-minute, Andrew. That's going to be your ticket right there.
Well, I'm going to say one thing. I agree with that, Judd. I'm going to say one thing. And I think Ira and Judd would know this because we've been around too long. The transmission mechanism in the next 10 years is going to be off the charts. And you know what it's going to be? It's going to be fucking currencies. It's the only thing left. And
What did you say? It's in the currencies?
It will be currencies.
Yeah, no,
We're going to go back to, you know, because people forget, you know, I know you guys don't, but dollar mark, you know, for the euro, those things used to move 5 big figures a day.
yeah.
I mean, that's a monetary policy in itself.
Andrew, I laugh when they talk about the volatility of the currencies. What volatility?
Oh my God. I was working for, I won't say I was working, but when dollar yen was at 80 and it was, and like someone said, oh, it will never go back to 100.
It was in 94, 95.
Yeah, but dollar yen came from 360 to 80.
In
360.
2011, in
Yeah.
2011, it was.
So my view is that basically we are in the 20s. Everyone's got to sharpen their pencil and work out how to trade currencies. Because the only thing that'll be left is the currencies, because they're taking rates to zero. Credit, oh God, no one's got a balance sheet to trade that as a personal trader. But you know, to Angelo's point, you know, I think there is an immense deflationary event coming, and it can come fast. If you're looking at volatility at the moment, it's still very elevated, even as it's come back a bit. And it can, because that vol's so high, it can just change overnight. You saw it this week, God forbid, the market's moved up and down 200 points, and it can change. And when they go, oh my God, we're going to, you know, let's just put a scenario forward. I'll put one, right? You know, Trump gets elected or Biden gets elected. I don't think it matters. The balance sheet's still the same. And they go, and the market's on its knees because it's on its knees. And then they go, you know, oh, we're now going to spend UBI, the Fisher paper. And then everyone goes, oh. So I will jump in RS overnight.
Well, and so would Lacey. If the Fed becomes a spender,
so will Lacey, exactly right.
if the Fed becomes a spender rather than a lender, I think he would switch too. Now, look, I'm. It's not that I don't see what they see. I do, but my sense of what the Fed will do can overcome a lot, especially with its role as the its third. What I've maintained for years is its third mandate, which is its responsibility to the international financial system, which we have seen play out quite a bit over the last 7 months. They've, you know, had to step up and fess up to that role after, you know, and the amazing thing was that Clarida, who did all that speaking about it back in 2019. So, I mean, it is there to be seen. And, you know, I'm just watching, you know, some of these plays that I'm looking at, and I go, you know what? Maybe yes, and maybe no. We're not there. Well, let me bring up. Lagarde actually got a question about deflation in the EU, and she said she doesn't really see it, and she doesn't believe that there's a deflationary risk in the EU at this point. And then, you know, and I'm just going to leave it there because I have some other views about it. And again, I think some people are operating on a playbook. And for me to say that it's Schilling, no, because Schilling's work is every bit as good and as long in as
totally agree. Yeah.
So these are two giants in this area who've been absolutely right, especially as far as bond prices. But
I think their point, Ira, is that it's probably not going to be just one thing. So, for example, you know, excessive domestic stimulus here in the U.S., right, in and of itself probably would not be a trigger for secular inflation, right? I mean, Gary makes the point that, you know, we're going to need domestic demand or global demand, if you will, to pick up steam. You get those two factors, all right, then you're definitely, that will light the fire for secular inflation. But unless some of these factors come together, I think that the key is going to be demand, domestic demand, global demand on the part of consumers. That, I think, is the key to the whole darn thing.
Well, Angela, that's why I was initially in that deflation camp, because I saw this much more as a demand shock rather than a supply shock. I mean, I did 3 or 4 podcasts with Bookvar and with Rosenberg, and they were much more in the supply shock camp back in March and April. And I saw this even back in February and early March, when I said that the Fed needs, and I have the blogs to prove it, that the Fed, prior to them doing it, open up the swap lines, because this is an economic shock coming far beyond anything you've anticipated, and cut interest rates 50 basis points. And Rosenberg said, well, cutting interest rates will have no impact. I said, this is an economic outcome. So I believe that we've experienced a tremendous demand shock when you lose all those jobs, and people who are at the bottom end of the economic ladder, who are just making ends meet, their demand gets curtailed. And then over the last 2 or 3 months, 4 months, we've seen that people at the top, their demand has been dramatically curtailed because there's just nothing to buy. There's nothing to buy. So I think that the system is still struggling. Football season without fans, to me, is a demand shock. Why?
You know what? Let me ask you a question, and hopefully this will come out right. Throughout 2019, bond prices were rising, right? Reflecting deflationary pressures. Yet, in the aggregate, demand throughout 2019 was substantially higher than what it is right now. So what makes us think that without demand, or the virus itself? I mean, we were slipping all along. So what makes us think that with aggregate demand having been substantially higher last year versus right now, that we're suddenly going to get inflation on a secular basis?
It's really, that's the same question that Schilling asked. So that's absolutely there. And that would be right, but you have artificially supported demand, right? We first of all, you have rent forbearance, right? That's an artificial stimulus to demand. You have Trump with the payroll tax cut. That puts more money, that at least sustains demand, right? We're sustaining demand. It's not being curtailed as much as you thought.
I don't even know if we're sustaining it. On a trending basis, I see the curve for demand going from upper left to lower right. All right, and so the support that's being provided right now, I don't even think is getting us up to the descending trend line.
Then the equity market is absurdly overpriced on that.
No kidding. Yeah.
Okay.
Agreed.
Right.
Absolutely agreed.
So, because if you go to that line, yes, and there will be a lack of demand, but will it be a monetary phenomenon with the inflation? Now, I'm not putting on my Milton Friedman hat. I'm just watching that you put enough money out there that things, stop going down, and you have all this money chasing. And I've seen it directly. I got a phone call yesterday in a deal that I've been in for years, believe it or not, a shopping mall in the western suburbs of Chicago that, first of all, in June, I was surprised that I got a quarterly check for. It's not a big thing for me, minimus really, but I was surprised with because it's all small businesses in the mall. The biggest business is a liquor store, Binny's, which is a big operation, and they're a good operation, but that's the kind of stores that are in there. And now the person who manages and put the whole deal together years ago called me and said they had they have a very attractive offer on the table. And do we want to, I said, well, why are you calling me? You're the one who making a decision. He says, because when I see what the internal rate of return is, 13%, if we sell it, even at this attractive value, are we shooting ourselves in the foot because we can't make that anywhere else? So I appreciated that he called me, but I have to sit and think this through. But there's money. My point is, and the reason I bring it up, there's money chasing things. Why would you chase, to me, a secondary, if not tertiary shopping mall? But there's so much.
I think that reflects the mindset of most of these valuation monkeys on CNBC, right? They're sitting here justifying valuations based on 21, 22, 23, and in some cases, 2024 earnings, without any regard for the path between here and there. You know what?
Well, okay, so that, and I would never put Stan Druckenmiller in that camp in any way, but when he comes up with his inflation call, when was it? It was yesterday.
No. That's a good point, because he did say that, but he also, what he did say though.
Yeah, a fear of deflation. I know.
Everyone. The reporting article was in Stan Druckenmiller's, he's a doyen of the game. No question about it. He must be listened to. What he said, as I did it from the whole interview, was that the Fed has raised the tail risk of deflation and inflation, both. And he kind of was going, I don't even know which one's going to happen. He feared inflation, but he said, I also fear deflation. Is that how you interpret it as well?
Yeah, no, he said that. Of course, the headlines come across on his inflation call, but he was in both sides. But
everyone in the market wants to hear the inflation call because everyone wants to fucking buy the stocks.
But I think the bigger point is this, and it's where I've always been, which is why I've been long gold for as long as I have, off. When I say long, I'm trading it from the long side for so long, because again, my sense of why gold was going higher was not because of inflation. That was for, again, those monkeys, but for the fear of deflation and the reaction to it. Central banks reacting to their greatest fear is the fear of deflation. And that's where I break from Hunt and Schilling and Rosenberg.
No, look, your call's been very, very good. I won't go as far as saying amazing, but you banked it. Good luck to you, and I bow to you again. But everyone's got to think through: is it just reflation, which is the dollar, because there's only two things they can do, right? Dollar and equity, which is kind of the same thing, really. The other three levers are over. If there's another deflationary shock, which the world can take out of their hands, a geopolitical event can export deflation immediately, because of the Hunt and Schilling theory just times the jaw burning out and forces the true end game, which they don't want to do. They do not want to spend because they know that's the risk of hyperinflation. They're not that stupid, right, Ira? They know that. They know
Yes.
they don't do that.
Yes. No.
But if they do that, they think they can control it. And if I say to everyone with their children, get the podcast of Lacey Hunt and read Gary Schilling. They say they hope they don't do it. They hope they don't do it. They're pleading to the authorities, don't do it. I'd rather you have deflation. That's what they say. I'd rather you have deflation and let's get through this as a kind society, because that's a better way through this. The other way is, I think he says, if they cross the Rubicon, inverted commas, it's a bad outcome. And I'm in his camp. All right.
Yeah. Listen, again, that's right. But my fear is that they go the other route because their fear, central bank fear of deflation. It's Ben Bernanke's entire mode of existence.
Oh no, you said it to me when I first came in this room. Lacey Hunt said it a few months ago. He said, they may have already done it. They may have already done it.
Hi guys, Richard here. Can I add to the discussion?
Of course. Go ahead.
I can't hear.
I think Richard was answering a telephone call, but if he wants to ask a question, he should just unmute himself and ask it.
Oh, okay, sorry. Yeah, can you hear me?
Yeah, go ahead.
Yeah, okay, sorry. Yeah, so I was just gonna say, like, I think the economy is showing a lot of forces that are deflationary, right? You got robotics, process automation, RPA, global labor arbitrage, all of that, the digitalization happening, all of these technology trends, right, move to online, you know, that point to more deflationary outcomes. But I think overall, there's something to be said, especially at this time, on the level of debt, right? The level of debt and deficits globally by governments is beginning to make an effect, to have an effect. You know, it's the idea that if the interest rates go higher, the servicing of that debt will just go, you know, to the point where it starts really bad on the economy. So if history is any you know, providing us lessons and guidance, it's probably going to go more in the direction of inflation, right? It'll be architected by governments in terms of the you know, fiscal policies and by central banks for monetary policies towards more inflation. Because the more inflation you get, if you do the math, like say 4% inflation over 10 years, you reduce the burden of debt by half. There's something like that on the math. So, you know, you don't want too much inflation, but if they can rev it up, I think is what they're thinking, they can reduce the burden of the debt in the indebted Western world. I think so.
Okay, so Richard, I won't take the question first because you know, your question was very smart. So I'll attempt my answer and I'll defer it to the really smart guy, Ira. But look, I think the conundrum that the models that the central banks have had for 30 years is that they thought they could create velocity, which is actually, you know, money through the system to get inflation. They have failed. Complete failure. The system is broken, in my view. So anyone who wants to talk about they are creating inflation today is not reading the playbook of Japan. They've tried it. Now, the Fed thought they did it too slow. Well, they've done it quick. It's not, the math doesn't work. And if you listen to people who've got it, and I look at people who've got it right, who run portfolios, who make money, so who are fiduciary managers of money for other people, like Lacey Hunt, who knows the system, credit on credit without an income on the credit, it's an output gap, it's deflationary. So I don't think jawboning creates inflation. I think inflation is what Lacey has articulated, which is actually if they then go and try to monetize the balance sheet of the Fed. So I don't think you can just create inflation. Ira?
Well, if it was that easy, of course, it would have been done with everything between Japan, rightfully, and other parts of the world. So output gaps certainly weigh. That's why I don't like the Phillips curve or Nehru, because they're domestically based models, and global wages are a global phenomenon when money can freely skirt around the world. Okay, but I take the Fed at their word that they fear deflation. Okay, I mean, I hear even Lagarde's comments today, they're all built on the fear of deflation. So can you stop it? I think when you, especially when you're the reserve currency, you have a much better quote unquote machinery in which to do that. And that's what frightens me. And you know what? The metals tell me that that's what they're frightened too. Because if the deflation, you know, then it doesn't really make sense that bond and gold go the same way. So the gold really feels that they'll keep pushing it until they find that magic point where you get, or what Lacey calls, you know, moving from lending to spending and monetizing it, that's the break point. And if you believe that the deflationary scenario continues to grab hold, well, then they have to keep pushing. And that's why the currency becomes so important to me, because that's where I can get an honest barometer. Because investors around the world will begin to get fearful of that, knowing that the Fed will not respond to it. This is not Paul Volcker's Fed. And the flexibility, to me, that Powell discusses is not the flexibility to raise rates. It's to do whatever he can to keep it going to get employment. Because if you get this right, you will get employment, you know, soaring back to that 3.5% level with all that fiscal stimulus around the globe. And don't forget, it is the 5, 6, 7% annual inflation that is the remedy to Rogoff's thesis in This Time It's Different. You need to run that to ameliorate the debt. Because why is deflation a problem for central banks? Because it makes the debt load that much more onerous, right? You can't raise prices. You're sitting there with debt. There's limited things you can do. You know, you have to pay down that debt. And who's paying down debt now? It's, you know, in areas where prices are rising. So you see mining companies, those that are managed well, are busy trying to pay down debt that they've accumulated over the years, because their pricing mechanism is soaring right now. There's so much to this. And the reason I feel the way that I is because the banks will bend as far as they can and go as far as they possibly can to prevent the onset of deflation. Well, that's what keeps me up at night, is that action, that reaction function to deflation. That's what keeps me up. And that's what's kept me in my gold fiat currency position over, you know, quite a while. Certainly, you know, I'm going back to 2002, 2003, because you could see it. And actually, I can take it back to long-term capital when I believe that Alan Greenspan made a categorical mistake, just like in May of 2013, Bernanke made a categorical mistake with the taper tantrum. And the Powell pivot reflected it too. So you see that they will go to any extreme to prevent the onset of deflation. Now, if deflation takes hold, then they've been totally wrong and their policies have been totally flawed, and the world will need an absolute restructuring of private and public debt. Now, will that in itself, release the forces of inflation? Probably, depending upon the way they do it. But that's the world. That's the way that I see the world. The debt load is far too great for them to allow any sense of deflation taking hold.
So I would argue, and that's a great call, because you're always better to trade with the wind than against it. And they have a bigger balance sheet than us put together. But if the overriding persuasion is deflation and they don't shift the predominant policy to get inflation, then I think you will still get deflation.
Or then the world is in a heap of trouble.
No, the world won't be if, as Lacey says, they will be forced into spending.
Okay.
Then you go from deflation to a hyperinflation.
Okay. So that's Lacey's take. And my sense of their spending, history bears me out that the quickest way to spend, of course, we know, which is, ramp up the military. And that's, that's part of the scenario. Does it play out? Hell if I know, but I know that they will go, the banks have told you, they will go to any extreme possible to stem the threat of deflation. So that's why I always thought that the Washington Redskins should change their name to the Washington 37ers, because it's 1937. That was the preeminent event that affected Bernanke's thinking about deflation. And okay, we're going to find out. Now, we know that the Fed has panicked probably twice this year, maybe 3 times. Is there one more panic in them before November?
Well, I would say yes.
Ultimately, at current prices, no need. But I guess it's like everyone's saying, nothing. I mean, everything will be forced upon when volatility is sitting at 60 to 80% higher. I want to remind everybody, 60 to 80% higher than the February high of this year in the market.
Yeah.
That means we are going to live this volatility every day of our trading life if you want to do this. So just get your parameters worked out. It's just going to, tonight's a bit quieter, but it may shift in a second because, and to my previous point, currencies used to be the greatest monetary tool of every central bank when the world wasn't global, and they used to use it against each other. As the world goes less global, I suspect that's what will happen. Currencies will be divisive and a fighting tool.
Oh yeah, that I can't agree with. Well, okay, this conversation can go on for a long, long time, and while it's important for the structural backdrop to my entire trading regimen going forward, on any day-to-day basis, because I have to bear up to what I bear up to, but there's a lot on this plate, and I think that the way that this breaks the course is going to set so much stuff in motion, and that's what we care about. Because, and then I'm gonna end this with this, because I think that you can't get away from it. It's just, it's there and it's overhanging the market. And I will say this, if people start to put on steepeners because, well, they see what we're talking about, that will set into motion the next panic, which of course will be an official announcement about yield curve control. Because we know they're already doing yield curve control by the way that they choose to buy whatever assets they're purchasing. But an official announcement would be the next stage of the panic. And I'm going to end that there and we can pick up on that, but I got to jump off and go.
All right. Thanks, Ira. And Richard put in here this Chapwood index as a good indicator for inflation, guys.
It's interesting how we line up on this. And Andrew, listen, I don't disagree with it. And Richard knows my thought process as well as anybody because we have an archive of 4 years, I believe, even before Richard was the one who was doing the moderating of the FIR podcast. And that's an extensively great library, by the way, and not just of my hits, but of a lot of other podcasts in which this is discussed. Instead of binge watching some Netflix, go dig into the FRA archives, and you'll find some really intelligent people discussing this issue. But I'm going to jump off. Thanks for allowing me the time to have this discussion with Andrew. I appreciate it. It's a very important discussion.
All right. Thanks, guys.